Turning to the outlook, in the first quarter of this year, growth slowed further to around 1.5 percentage points annualized, and it now appears to be decelerating again. The most recent weakness reflects in part the forthcoming referendum on the UK's membership of the European Union, which has pushed up uncertainty measures to levels not seen since the euro crisis. The referendum makes describing the outlook for inflation more challenging than usual. That's because some asset prices used to condition the committee's projections are likely to have been affected by market participants' perceptions of its consequences. A vote to leave the European Union could have material economic effects on the exchange rate, on demand, and on the economy's supply potential, effects that could affect the appropriate setting of monetary policy. The recent behavior of the foreign exchange market suggests that were the UK to vote to leave the EU, sterling's exchange rate would fall further, perhaps sharply. This would likely be consistent with changes to some of the real fundamentals that drive sterling, including the terms of trade, productivity, and risk premia. In isolation, a further fall in sterling would boost inflation over the policy horizon. Aggregate demand would also likely fall relative to our forecast in the face of tighter financial conditions, lower asset prices, and greater uncertainty about the UK's trading relationships. Households could defer consumption and firms delay investment. Global financial conditions could also tighten, generating potential negative spillovers to foreign activity that in turn could dampen demand for UK exports. All else equal, lower aggregate demand would tend to reduce inflation over the policy horizon. However, over time, there may also be negative effects on aggregate supply, including slower capital accumulation and the need to reallocate resources across the economy in response to changing trading and investment patterns. On their own, such supply effects would tend to boost inflation over the policy horizon. So this combination of influences on demand, supply, and the exchange rate could lead to a materially lower path for growth and a notably higher path for inflation than in the central projections set out in today's inflation report.